The old way of keeping receipts in a shoebox and filing one tax return a year is ending. The new system requires digital records and quarterly reporting. The key point is this: you are not paying tax every quarter. You are only reporting income and expenses. Tax is still calculated and paid after your final yearly submission. Please subscribe this channel for more important video like this. Making Tax Digital is a reporting system that requires landlords and self-employed individuals to keep digital records and submit updates to HM Revenue and Customs every quarter instead of only once a year. The quarterly updates are not tax payments. They are simply summaries of your income and expenses for that 3-month period. The rollout is phased, starting with individuals earning £50,000 or more from property, self-employment, or a mix of both from 6 April 2026. The £50,000 threshold is based on your 2024 to 2025 tax return, meaning your earlier income determines when you enter the system. From 6 April 2027, the threshold drops to £30,000 based on your 2025 to 2026 income figures. Even if you are not affected in the first phase, the thresholds are reducing quickly. It is clear that most landlords will eventually be included. From April 2028, the threshold drops again to £20,000, and HMRC expects around 85 to 90% of landlords to be inside the system by then. Once you enter Making Tax Digital, you must stay in it for at least 3 years, even if your income later drops below the threshold. If you qualify in April 2026 and your income falls in the following 2 years, you still remain within the system for that minimum period. Receiving or not receiving a letter from HMRC does not decide whether you are included. The legal responsibility is on you to check and register. Now you must actively notify HMRC that you are required to follow Making Tax Digital. It is not automatic. This is not something you can ignore and hope it goes away. The responsibility sits with the individual landlord, not just with HMRC. Limited companies are currently not included in Making Tax Digital for income tax, so company-owned properties are not affected at this stage. Partnerships and LLPs are also not currently required to join, although this could change in the future. Jointly owned properties between husband and wife or family members are assessed individually. Each person checks their own share of income against the threshold. If a property generates £60,000 and ownership is split 50-50, each person considers £30,000 when checking whether they qualify. If you own most properties through a limited company but still hold one personally, that personal income could bring you into the system. Having most properties in a company does not automatically protect you. Even one personally owned property can trigger the reporting requirement. Every transaction must be recorded digitally. It is not enough to submit one final total at the end of the year. You will effectively complete 4 mini tax returns each year, covering income, mortgage interest, repairs, insurance, and all other allowable expenses. Mortgage interest may require closer monitoring because lenders usually provide annual statements, not quarterly ones. If exact interest figures are unavailable quarterly, you can make a reasonable estimate and correct it in your final annual submission. You still complete a final yearly tax return, which reconciles all 4 quarterly updates and calculates the actual tax due. Making Tax Digital is about accuracy, transparency, and real-time reporting. It does not mean 4 tax payments a year, but it does mean better organization. The earlier you prepare by speaking to your accountant, choosing suitable software, and separating your property finances, the smoother this transition will be. Please don't forget to subscribe my channel. Thanks for watching.